Ladies and gentlemen, good day and welcome to Birlasoft Limited Q2 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikas Jadhav, Head Investor Relations, Birlasoft Limited. Thank you, and over to you, Mr. Jadhav.
Thanks, Nirav. I'm Vikas. Good evening to everybody. I'm Vikas from IR, and joining us today on this call we have our CEO and MD, Mr. Dharmendra Kapoor, DK, CFO Chandrasekhar Tyagarajan, Chandru, Roop Singh, our Chief Business Officer, Sri Rangnath Kulkarni, who is our Chief Delivery Officer, and Arun Rao, who is our Chief People's Officer. We will begin this call with opening remarks from DK, followed by Chandru, and then move to the Q&A session. Please note that anything that we say on this call and refers to the company's outlook for the future is a forward-looking statement and must be read in conjunction with the disclaimer which we mentioned in our Q2 investor update, which has been uploaded on the stock exchanges. I'll now hand over this call to DK. Over to you, DK.
Thank you, Vikas. Good evening and welcome to Birlasoft's second quarter financial year 2022 earnings call. I sincerely hope you all are keeping well and doing well with your respective businesses. Let me provide some color to our quarterly performance. Quarter 2 revenue was at 136.9 million, which is up 6.7% quarter on quarter and up 18.4% year on year. The revenue growth momentum has improved significantly in the past 4 quarters and has clocked a CQGR of 4.3%, which is quite encouraging. Our commitment to create an organization that is predictable and sustainable is showing result, and as we grow quarter on quarter consecutively for 4th quarter. The deal win momentum continues to be good, and we have won TCV deal wins of 140 million this quarter, of which $104 million came from new business. The share of digital deals and transformation programs are increasing post-COVID. The clients are also pushing for deal structure that is modular in nature, and hence that would mean there will be series of smaller deals than monolithic large deals. Hence, this has led to increase in the ACV revenue, which is apparent through quarter-on-quarter growth that we are showing, but it will provide lesser or delayed visibility to TCV revenue. Hence, TCV wins may not look as large as we have seen in the past. After winning a good pickup in the net new business in quarter 1, this quarter saw a significant jump in the net new business, which contributed to approximately 37% of the total wins versus 13% in quarter 1. In fact, a multi-million-dollar deal this quarter, including a TCV $20 million large deal, were from the new clients. The increase in net new wins is clear result due to many clients opening up for discussions and ready to meet face-to-face as part of the evaluation process. In fact, I personally spent a couple of weeks in US in the month of August and a couple of weeks in Europe in the month of September, and I could clearly see openness to invest in emerging demand and opportunities. And that is what is demonstrated through the quarter 1 net new wins that we are showing. Most importantly, the quarter's growth was very broad-based across all verticals and horizontals. As you may have seen from reported quarter 2 wins, there is a good increase in the enterprise solution deals, and these are across upgrade, new implementation, and transformational deals. Enterprise solutions grew 1% quarter on quarter. Cloud and base services have shown significant growth and have grown 19.1% quarter on quarter and 51.8% year on year. Similarly, the business and technology transformation saw a growth of 6.2% quarter-on-quarter and 29.2% year-on-year. We are more optimistic today in almost every segment of technology than we were about 6 months back, which also is demonstrated in 50% increase in our deal pipeline. Even on the vertical side, we saw all-around growth. Our focus verticals like BFSI and life sciences have grown 10% plus quarter-on-quarter and approximately 15% on a year-to-year basis. Manufacturing grew 4.9% quarter-on-quarter and 21.8% year-on-year. Even ENU, which saw subdued growth last year due to factors like oil prices, with crude oil pricing stabilizing at higher level now, we are seeing good pickup in ENU vertical as well, and it grew 12% year-on-year. Growth also continues to be driven by large customers with top 10 and top 20 clients, revenue growing over 8% quarter-on-quarter and over 21% on a year-on-year basis. Although there was a marginal decline in the active customer count from 291 to 280, the revenue growth from ex-top 20 customers was also up 4.7% quarter-on-quarter and 10.8% year-on-year. Our customer count of 10 million plus revenue improved by 2 this quarter, 3 in year-on-year basis, bearing the testimony to our mining and cross-selling efforts and focus on top customers. EBITDA in absolute terms was flat at $20.5 million quarter-on-quarter, and EBITDA margin for quarter 2 was up from 13.9% in quarter 2 financial year 21 to 15% in quarter 2 financial year 22, while it saw a drop of 98 bps quarter-on-quarter. Margin was impacted due to wage hike, hiring, increase in the subcontractors' expenses and investments. Despite a significant pickup in attrition seen across the sector and across the industry, we managed to improve our utilization marginally to 85.8% in quarter 2 from 85% in quarter 1 and 83.7% in quarter 2 of the financial year 21. PAT stood at 14 million versus 15.4 million in quarter 1. PAT was down primarily due to lower forex gains in quarter 2 versus quarter 1. The manpower headcount at the end of quarter 2 stood at 12,065 and saw an addition of 557 professionals quarter-on-quarter and 2,055 on a year-on-year basis. The attrition is a cause of concern definitely for the sector, and our Q2 LTM attrition stood at 24%, which is the highest till date for Birlasoft. However, I believe that this elevated attrition is due to pent-up demand and pent-up attrition, which hopefully should soften in about 1 to 2 quarters, and we should see that the attrition will soften in next 90 days to 180 days. As freshers get into the billable roles and travel opens up, we expect attrition to taper down in the next couple of quarters. We have added over 430 freshers in H1 alone. As far as work from office is concerned, our leadership team has been working from office for the past couple of months. We have also started to broaden our presence to work from office. However, we clearly know that we will have to adopt hybrid work environment and will have to provide role-based flexibility for our people to work from office, home, or client locations. Birlasoft continues to get various recognition. It was named a top 15 sourcing standout by ISG and among the leading providers in the booming 15 category globally, as well as for the American region based on annual contracted value won over the last 12 months. This is the 6th consecutive time that Birlasoft has been featured across named category by ISG. The company was also named a leader in SAP S/4HANA system transformation. It achieved service expertise in JD Edward applications to Oracle Cloud and Oracle E-Business Suite applications to Oracle Cloud. Furthermore, Birlasoft was named a finalist of 2021 Microsoft Partner of the Year award in the application modernization category. In Q2, we also announced a strategic partnership with Freshworks Incorporated to help global enterprises nurture and supplement their digital transformation program by delivering enhanced customer experience management services. To conclude, the demand environment remains robust, though some supply side challenges are likely to continue in the near term. We remain quite optimistic with the order booking, deal pipeline, and the opportunity for growth. With this, I would like to hand over the call to Chandru for providing more details on our financials. Over to you, Chandru.
Thank you, DK. Good evening, everyone. Let me take you through some of the financial highlights for the second quarter of FY22. Our revenue was 136.9 million versus 128.4 million in the previous quarter, and that's up 6.7% quarter-on-quarter and 18.4% year-on-year. We had a cross-currency headwind of 47 basis points. Therefore, the revenue growth in constant currency terms was 7.2%. In rupee terms, revenue crossed the 1,000 crore mark and stood at 1,012 crore, which was up 7% quarter-on-quarter and 18% on a year-on-year basis. The EBITDA for the second quarter, as DK said, was at 20.5 million, flat quarter-on-quarter, and up 27.5% year-on-year. In rupee terms, our Q2 EBITDA was at 151.8 crore versus 151.1 crore, marginally up by 0.5%. Our EBITDA margin was at 15%, up 107 basis points year-on-year, but down 98 basis points quarter-on-quarter. The impact on margin came from wage inflation. We had wage inflation. In addition, we had some increase in our subcontract expenses. We also had some investments, strategic investments that we made in the second quarter. Margins were helped by volume growth and operational efficiencies that we continue to push. Our PAT for the second quarter was 14 million versus 15.4 million in Q1. PAT was lower in the second quarter due to lower other income, which was down from 2.9 million in the first quarter to 1.3 million in the second quarter. And that's primarily because the quarter end rate of the INR to US dollar was almost flat in the second quarter versus a depreciation of about 1.7% that we saw in the first quarter over the fourth quarter of FY21. Therefore, in Q2 FY22, there was a revaluation gain versus only a very marginal gain in Q2, and that led to a lower forex gain in Q2 of about 1.5 million. Which explains the reduction in PAT on a quarter-on-quarter basis. DSO, we continue to do well in our collection and our DSO. Our DSO stood at 54 days, which is flat on a quarter-on-quarter basis. However, it improved 4 days on a year-on-year basis, and that's the lowest to date that we've done. Our cash and cash equivalents stood at 144.6 million. It is 1,073.6 crores as of 30th September of 2021 versus 154 million on 30th of June 2021. Cash was up 20.3 million on a year-on-year basis. The quarter-on-quarter cash was down primarily on account of dividend payout and also additional working capital resulting from the growth in our business. CapEx for the quarter was 2.4 million, and all of this is primarily on IT assets that we've had to procure to support the growth that we've had. The board announced an interim dividend of ₹1.50 per share, and this is an increase of 50% over the prior year interim dividend. Overall, the financial metrics remain stable, and we continue to strive to better them on an ongoing basis. With that, let me throw the floor open for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Vaidik Sarkar from Unifi Capital. Please go ahead.
Okay, hi, good evening, and congrats on a very strong headline number. A couple of questions. Your cloud and base business seems to have broken out very well this quarter, almost 20% sequentially. Could you perhaps flesh out this practice line for us and the ISVs that are moving this number? How do you see this pan out? And importantly, how much of this is project versus annuity based today?
I'm sorry, Vaidik, if I understood the question right, you said that we have grown well on the cloud and base services. You want me to elaborate on that, right?
Yeah, if you could just, flesh out the ISVs that are moving this for us and, how do you see this panning out? And importantly, how much of this practice line is annuity versus project-based? Yeah.
Okay, excellent. So I would give the data of the breakup between the annuity and the project base just for that segment. I probably will not have it very handy, but we can provide you that data.
Sure.
But I think our annuity definitely stands closer to 70% at the overall portfolio, which is what we have been maintaining because the deal structures are changing. I was really hoping that from 70% we start moving up, which will happen eventually. But if you look at during this time in the H1, a lot of deals that are coming are the ones which are pent-up demand because these are the transformational programs that have been there that was stopped last year and they have started in this particular year. So from that perspective, if you look at coming in the current year than usual because the clients are trying to catch up with the projects that they had stopped earlier or had put on the slow burner. Second, when it comes to the cloud revenue, for us the cloud revenue has started improving because you would have noticed that we have had our partnerships stitched with Microsoft, with AWS, with Google, okay? We have stitched our partnerships in place. And there is a significant interest that we are seeing in the application modernization category because that is where right now there is a significant momentum that is there. A lot of clients who thought that they should move to cloud at some point of time because of pandemic, they think that they were better off if they had moved to cloud already. So now they are in a hurry to really move to the cloud for their critical infrastructure and application so that in case anybody will have to work from any location, it becomes much easier for them to do that. So that is, I think, bringing up some advantage in that category also. So from that perspective, I believe that there is a good momentum that we have started capturing on the cloud side because that's what was our plan while we were stitching these partnerships.
Sure. And, now that the wage hike quarter is behind us and given the pricing environment in the industry, would you reckon we revert back to our 15% EBIT margin sooner than later?
So that's the plan, absolutely. And I really wish that the attrition was not as strong as everyone has seen in the last 2 quarters. But I continue to maintain my view on the attrition that it is going to start softening by the end of this quarter. and it will soften to a good extent by end of the next quarter. I know these are the opinions. Many others have the opinion that no, it is going to stay for long. I believe some level of attrition will stay for longer, but I think it will soften by quarter 4 end, because the pent-up demand we would have gone already. At the same time, the pent-up attrition would have also softened. So that means the bubble that we are seeing, in which people are moving from one company to another company, that will burst and probably it will soften. So yes, that is the plan, because our goal is definitely that we deliver the EBITDA and EBIT at par with the industry, and we want to continue to move towards that. And you're absolutely right that the salary hike is behind us. We need to look at how do we make the talent supply chain effective. That is what we have been doing in the last 2 quarters. But generally, when you bring in the fresher, it takes 2 to 3 quarters before it starts showing the result. I believe that it should start showing us the result on that front now, and we will see some advantage coming in.
That's helpful, DK. Thank you so much. I'll be in touch.
Thank you, Vaidik.
Thank you. The next question is from the line of Sandeep Agarwal from Edelweiss. Please go ahead.
Yeah, hi, good evening, and congrats DK and team for the excellent execution this quarter. So DK, I have one question on the order book. What we understand from the industry experts and when we speak to a lot of consultants is that the demand is extremely strong, and you have delivered good set of numbers, no denial on that. But the order book still doesn't reflect that. Is it that you are not intentionally taking some of the clients, or you're saying no to few clients because either the pricing is not matching up to your expectation, or your attrition situation is such that you don't want to get into a situation where we can have some execution challenge? Is it the reason, or is there some other reason why our order book is not as strong as it should reflect the way demand situation is and the way the attrition is showing up? So any idea on that front would be...
No, absolutely. It's a good that you asked that question, because the way we look at generally the order book for us is that, or even when we show the TCV or ACV and all that, we generally show the deals that we win in a composite manner, okay, either in the form of a project or in the form of a deal. That is what we count in the form of wins. But then there are other things that we continue to grow our revenue on, which is many of the time and material engagements where there is some change request that comes into the play, or we grow our existing running engagement by adding some resources on top of that. We generally don't count that into the TCV and ACV, because if you start counting that, then there are so many small things that you need to put together. While those small things can put together do look good revenue also, but that is not what we count in our order book, because then it becomes very difficult to start tracking for that. I think the way we have to look at it is that the order book should be a clear reflection into the quarterly revenue that we make. And when I look at it from that perspective, I think it is sounding very, very good for us, because we are able to grow in both quarter 1 and quarter 2 much more than that we planned internally as our own goal. At the same time, in comparison also in the industry, we have shown good growth in the quarter 2. So if I look at my order book, if I look at the number of wins, and I look at my deal pipeline, I am very confident that we are capturing the momentum in a very, very handsome way. There where we sometimes do say no, and these are the deals where we believe that that either the price is way too low, or we believe that the scope is being defined in such a way that there will be effort overrun and then there will be a cost overrun. So you may win actually the contract in the first place, but you are going to bleed very, very quickly in that particular engagement. So we have started evaluating and started doing go, no-go analysis far more carefully. So that is there, but I don't have a figure that I can quickly give it to you that how much you would have said no to, but then there are few things that we definitely say no to.
So, DK, thanks for that elaborate answer, but a follow-up on that. See, the way we look at, and we have limited information, and as you rightly mentioned that you have far more information than us, but we can only compare the numbers quarter on quarter, and when we do that, then, it looks like there is a little lower momentum on the deal wins compared to the industry demand. I take your point that, the actual quarter growth is very good and you seem to be very confident. So, will it not be fair on your part to, guide us something at least on the long-term basis, which you have been guiding? So if you can reiterate what is your thought process, given you have now seen 2 quarters of this year and you have good order book and you have some visibility into next year. So what should we build in from a 2-3 year perspective, overall revenues? Where do you see we will touch the revenues, including inorganic, organic both, and where do you see the composite margins to be? Any idea on that front will be very helpful, because otherwise it becomes very difficult because there are so many things which, as you rightly said, are not disclosed for clients confidential and other reasons. So if you can
The intent is not correct. No, I think it's a fair question. The intent is not share those things. The intent is to provide the right information. And I'll give you one example. I did talk in my opening statement also. One is looking at the TCV number. Second is looking at the ACV number. Third is looking at the new business. So if you look at within the TCV, how much is a new business and how much is the repeat business? Because the repeat business doesn't give you any incremental revenue. A lot of time one can show that my TCV is higher, but if your repeat, if it is consistent of mostly repeat business and you're done renewal, that means there is no incremental revenue that you're going to get. If you look at carefully the last quarter and this quarter, we have significantly improved on the net business, net new business, okay? On 2 things, that there is a new business that is coming from our existing clients and new business that is coming from the new clients. It has significantly improved, okay? That gives me the confidence that my ACV is getting better, my new business is getting better, my net new or new logos are getting better. There is no reason why I would not go and demonstrate better quarter-on-quarter growth. However, if my TCV was higher, whereas my renewal was also very higher, then there could be concern that it is a repeat business that I'm showing as a win and not really the new business that I'm showing as a win. So I think that is the subtle difference in the number that comes into the win. I am very confident because the new business that we are winning has started to improve a lot, and the net new wins has significantly improved in quarter-over-quarter. Last year, if you look at it, was very low because no client was meeting. But we picked up this momentum in the quarter 1 and quarter 2 to start meeting our clients in US, in Europe, in India, everywhere. And that has started seeing that we have started closing new deals. Now these new deals, a lot of time will start small and will grow bigger over a period of time for simple reason that whenever there are digital deals that are coming, to begin with, it is a smaller deal. The second one will be even bigger. The third one will be much longer because it actually results into support and maintenance annuity revenue also. So we have to understand the nature of the digital deal, which is very different from the enterprise solution deals.
Okay, thanks. That's very helpful. So when do you expect to touch $1 billion revenue?
March 2025, we will be $1 billion.
Okay, thank you. And that will be at a very healthy
that goal remains. Yeah, that goal remains. And we said that we want to touch 18% EBITDA at that point of time.
Thank you. Thanks a lot, DK.
Thank you.
Thank you. The next question is from the line of Mohit Jain from Anand Rathi. Please go ahead.
Sir, one was on the enterprise solution side. So that service line was little on the weaker side. What should we expect there going forward? That's one. And second was there was this bump up in other expenses from a quarter-on-quarter perspective. So what kind of expenses were these, and what happened during the quarter?
I'm sorry, just repeat, Mohit. Just repeat the second part of the question.
So there was a bump up in other expenses on a quarter-on-quarter basis. So was there a one-time cost or something which you guys took in this particular quarter, or should we expect that as a new other expenses number?
Yeah, I'll give the answer to the first question, and I would request Chandru to provide the answer for the second part of your question. On the enterprise solutions, the good news is that we have started seeing the growth. Okay? In fact, in this quarter, there is no part of the business that has not grown. Every single part of the business has shown positive growth, which is very good actually, because whether it is geo or whether it is vertical or horizontal, everywhere we have shown the growth. And I'm very happy that the transformation deals have started to come by, because last year we saw that there was a dip in that, and this year we are seeing that it has started to improve upon. At the same time, we defined our strategy clearly very well that we need to have our channel sales strategy to be positioned in a different manner so that it can continue to focus on net new business under enterprise solutions by working along with the OEMs. And that has started to show us the benefits, so that is also very encouraging. So from the enterprise solution perspective, I believe that we have started doing very well and we have grown positive in this particular quarter. That it is going to happen the same way going forward, because I'm seeing better pipeline than before. So that is one way of looking at it. Second way of looking at it is that as the organizations are planning their digital journey, they are realizing that they may also have to transform their enterprise solutions also, such as SAP, Oracle, okay, or JD Edwards. They will have to transform that also, because sometimes you are not able to get the real advantage if your processes behind that are not strong enough and agile enough. And hence, we have started seeing the deals which are to transform or improve or upgrade the enterprise solution so that the clients can implement digital layer on top of that. So those kind of deals are also giving the fillip to the revenue that will come into the enterprise solution. So looking at this point, and when I look back that we kept our strategy around enterprise digital, that digital always sits on top of the core solutions such as SAP, Oracle, JD, Infor, ServiceNow or Salesforce. That is coming to be true because clients are realizing that the entire data lives in the transaction processing system, which is the ERPs. They have to implement the digital, they need to depend upon the data that is below in that layer. And that has started to give us the advantage, and I believe that we will be actually winners by having that strategy in place and having our strengths pretty much balanced between enterprise solutions and digital. Chandru, over to you for the second part of the question, which was the question on the other expenses.
Sure. Thanks, DK. So the other expenses, this is where the subcontractor expenses actually get included in. And, I talked about in my opening remarks the increase in subcontractor expenses on a quarter-to-quarter basis that has added to our costs in this past quarter. And this is to meet the demand and also to wade through the supply chain challenges that we've had this past quarter. So that's the primary driver for the increase in the quarter-to-quarter basis. And we expect that as travel opens up, as the talent supply situation improves and the attrition situation improves, we expect to bring that back into a steady state, I would say.
Okay, and so as a follow-up, like you were talking about these smaller deals, $1 million and $5 million clients were a little on the lower side for us, specifically during the quarter, also over the last 2-3 quarters. So what is causing this movement, and how do you expect this scale-up to happen, along with your commentary on lower side or smaller deals compared to the previous one?
Sorry, what was the question? I missed it. I'm not sure if you got the question.
$1 million and $5 million clients, that bucket was on the lower side if you look at addition over the last 12 months or so. While you commented that deals are becoming smaller and therefore some of it is not getting captured in the TCV. So how do we, what is the expectation there from a smaller client addition perspective?
No, I think our actually the larger deals, $5-10 million are started to improve. So some of the deals are seeing the movement also. At the same time, we are also looking at that many of the $1 million deals are generally the projects. Okay, we still have a significant 25 to 30% of our revenue coming from the non-annuity business, which is a project-based business. So that means that we have to continue to work in order to win more and more projects. So there will always be some quarterly variations that will happen. But so far, when we are continuing to show the growth, which is much above the target that we keep for ourselves on quarter-on-quarter growth, I don't think that should be a concern. Because most of these things are generally the one-time projects, and we continue to make an attempt that when the project is finished, we continue to win more projects with the customer. So sometimes there will be variation from quarter to quarter. And that is especially going to be in the category of 1 million.
Understood, sir. Thank you. I'll get back to the question.
Thank you.
Thank you.
The next question is from the line of Shraddha from Asian Market Securities. Please go ahead.
Yeah, hi. Congratulations to the management team on a very strong execution. Sir, just wanted to check that you had initially indicated of a double-digit growth in FY22. Now with a very strong 2Q, do you think at least a 15% growth is what you can easily commit to?
So, absolutely. I think that always been our goal that we should show 15x15. That has been our strategy. So I'm pretty confident that we will be able to achieve that. Don't read that as a guidance from my side, but we are definitely very confident.
Sure. And do we also see some impact of furloughs in 3Q, or would 3Q also be an equally strong quarter for us?
So it is a very interesting, thing that we want to see how it pans out in the current quarter. One or two customers we have heard that they may plan to have a furlough. But we are also trying to really work out that on one side there is a pressure from our clients on getting them the resources and have a quicker time to market. On the other side, why there should be a furlough. So we are trying to really look at that if any such case is coming, we go and negotiate with the client that how can we cover up without really getting any furlough impact in the month of December. So we are having the discussions with our clients. So far, it is not looking to be a big impact so far. But generally, I have seen that there are always a couple of clients who will bring the surprise only at the last moment. But then we are already in touch with those cases where we think that kind of surprise can come, and we are trying to mitigate that risk.
Right. And secondly, on margins, despite a very strong 1Q, we had indicated that our full year margins would be 15%, and now in first half our margins are already at 15.5%. And we had said that we would like to build some cushion because of supply side challenges. Now with first half margins already at 15.5% and salary headquarters already out of the way. So do we see margins improvement going into the second half, and then how should we look at full year margins?
I think the biggest focus that the organization today have is to address the margins. Because when you are looking at the margin, that means that you have to look at many other parameters in parallel to that, be it talent supply chain, be it induction of the freshers, or looking at reducing the cost per resource, or looking at the delivery cost, or going and trying to negotiate better prices with the clients, or even trying to go and negotiate with our clients. So there are multiple initiatives that we have started in that direction so that we can address the margin, because that is the key focus right now. I think the growth we are far more confident today based on the structure that we have created with respect to our sales as well as our large deals. So now that we are very confident on that, we have to really look at how do we address our margin also, because it is a near term where of course everybody is getting hit with the whole attrition and other things, but there is a way to address it, and we are already working on that direction.
So directionally, how do we look at Q2 margins? I mean, should it be stable or?
Directionally, I think it should be positive. We should move positively in the quarter.
Sure. And so just one bookkeeping question. In the segmental margin breakup that we have provided, I see the manufacturing margins being down almost 400 bits on a sequential basis. So anything particular we might want to call out here?
Sorry, just repeat that question again, Shraddha.
The segmental margin for manufacturing business segment is down almost 400 bits on a sequential basis.
Yeah. So if you look at that, when we talk about the manufacturing and all that, that is where we are yet to get the real price advantage. In some of the other cases where we have started negotiating the better prices, I think that has started happening. In manufacturing, we are little bit trying to achieve that. So I believe that we should be able to pretty much catch up with manufacturing also during this time. At the same time, if you look at every single industry, manufacturing is one industry which is far more cost efficiency focused themselves. Okay, so from their side, you will always see the price increase slower than the other industries such as life sciences or BFSI, because they are far more growth-oriented industries when it comes to the technology. So I think it is the nature of the industry that the speed you will see at different pace.
Yeah, so that's helpful. And just one question, if I can. So, I mean, was there any revenue we could not capture in the quarter because of fulfillment issues?
No, I don't think so. I think we have been really working very hard on really hiring and everything. I don't recall where I'm sure there will be some time and material engagement where there could be something in the captive side where we may not have captured some part, but it is going to be very insignificant.
Sure. Thank you so much and wish you all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity and congrats on good execution. DK, just wanted to understand, looking at the attrition spike and that too on a LTM basis, which is one of the highest in industry for any company. So on a quarterly annualized, the attrition could have been at a much higher level in a quarter. So despite that, the absolute employee cost on a Q-on-Q basis has gone up by just 3.7% despite wage hike. So whether the wage hike has been given for part of the quarter or it has come for all the 3 months for the Q2 and may not repeat going forward, that's the question number one.
Okay, so we did that from the month of August. So what you're seeing the impact is for August and September in the quarter 2.
Okay. And you believe for any further hike possible going forward to control the attrition or a second round of wage hikes in the Q3, Q4?
No, it is not going to be, there will not be a hike across the board. Now, everybody knows who deals with IT industry that there are always going to be selective cases where you may have to have some retention. And our objective is that we keep the retention as a long-term incentive rather than just changing the hike for the people, because just changing the salary structure has far bigger consequences. So we try to address it through the long-term incentive that we provide in order for us to address the attrition.
Okay. And despite 1 month of wage hikes pending in Q3, furloughs being there, plus maybe some selective retention measures you are taking, you are saying Q3, Q4 margins will be better than Q2, or you are saying it may be in the similar range as of whole? Because for Q2 also we are talking about flattish margin, but we could not achieve.
Correct. And I mean, we didn't know that quarter 2 attrition is going to be far higher than the quarter 1. Okay, nobody thought about it, but that's how then we started facing it. And it only started to become stronger when the talk was happening that there will be a back to office strategy that everybody will put in place, which is not yet put in place. So the plan that we are working on, that we have identified the lever that we need to address in order for us to improve the margin quarter on quarter. But then there are always some of the surprises that can happen. But if I look at the attrition, okay, for the last now 1 month, it is more flattish, and in some cases it is little lesser rather than it is picking up the pace. So if I look at from that perspective, I believe that there will not be any surprise. There is one surprise that definitely there, that the furlough can happen with our clients. Yeah, that surprise is there. So far, it looks like that we'll be able to address it. I think if we are able to address these couple of challenges, then in my opinion, we will show some improvement in our margins.
Okay. And DK, you worry about high attrition impacting your delivery capability, execution capability, demand fulfillment issue in the Q3, Q4, or you still believe those won't be a problem to look for in the future?
You are saying that whether demand fulfillment and all that will be a problem in the future or not?
Yeah, because of attrition being so high, there could be some time and material contract where you cannot replace the employees so easily, and that can impact your project ramp up by maybe few months as a whole. So will it impact the sales ramp up in Q3, Q4?
Correct. So first of all, just let me explain that it is not an issue of just time and material. At that time, client can put a finger on someone and equivalent experience and may demand similar kind of profile. But you can always negotiate with the client. That is one thing. Second, in the fixed price, just because I can go and put a junior person without discussing that with the client doesn't mean that I can do so, because at the end I'm responsible for the execution and delivery. And if I bring the people who are not able to deliver it, it doesn't matter how low the cost is, I may get into effort overrun, and that would mean that I may have a lower cost resources, but because of the effort overrun, I may still end up spending the same amount of money. Okay, so both the sides have the issues. What I believe is that the nature of the work going forward is not going to change significantly. The digital deals are going to be there. Enterprise solution deals are going to be there. Some level of momentum will remain. Okay, probably the pent-up demand is going to go down, but rest of the momentum is going to remain. So there is going to be definitely an attempt that how do we get the supply chain right by start bringing in the fresher, take a little bit of hit in the shorter term, but in the medium term to longer term, we create an engine that can fulfill within rather than always depending upon the external parties or external market. That is what we are working on. And on the shorter term, I believe that most of the companies will continue to face that challenge. But I think everybody will work towards finding a solution. I believe for IT industry, if we ignore the short-term challenge that is there, I think we are in a good situation because it is going to create a model that was long awaited and will probably create an environment of hybrid work, at the same time being able to create more methods of creating the talent, whether it is in India or it is in the Eastern Europe or it is in the Americas or it is in the Philippines. There are all those attempts that we have started to make so that we can broad base the talent supply.
Okay.
Good news for the IT industry.
Yeah. And the last question is just on the enterprise solution. So this used to be a leaking bucket for a right reason. But as you are saying, most of the demand, the deal wins are happening on SAP and the Oracle upgradation. Is it you believe the worst is over and the enterprise solution 41% revenue contribution may have some further upside rather than the downside as a going forward?
Yes, I believe definitely so that the enterprise solution will show positive, movement now, for simple reason that the clients have started to understand that they need to also strengthen their legacy platforms, and hence they have started to invest back into those systems also. So I definitely believe that this area will continue to give us a good growth, and good part of our revenue will continue to come from the enterprise solutions also.
Okay. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Abhishek from InCred Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congrats on a great execution. The first question is on the sales and support employee. I mean, we've been just ramping up that number significantly over the past 4 quarters. When could we see that reflecting in our higher bookings number? That is first question. And second, I may have missed it, but did you quantify what was the subcontracting contribution this quarter as a percentage of revenue? And the last thing is I'm going to ask this again. You have answered it in part earlier in earlier questions. But this is on the ERP side. So, 40% of our business is dragging the 60% of our business. So should we expect that, once this pent-up cycle is over, maybe the ERP business can help us grow, 4% CQGR longer than, some of the other companies, because as a percentage of revenue, ERP is substantial in our books. So if you can address that would be helpful. Thank you for taking my questions.
No, thank you. I think very pertinent questions. So order booking is definitely growing. It is just that you will see one difference, that if there were deals 3 years and 5 years earlier, these are the deals now 1 year and 2 years. Okay, that's the only difference. I believe that otherwise our quarter-on-quarter growth is indicator that we have a much better order booking. Our new wins is also an indication that it is a better order booking. At the same time, the ACV value being better than previous quarter is also the indication in that side. So I am happier with this situation rather than showing higher TCV value but lower ACV value. Okay, so that is one thing. On the subcon side, maybe Chandru, if you can let me know what is the percentage that we have right now, or maybe Arun, if you have the subcon percentage handy with you, the data.
I have the data, DK. Subcontractor expenses as a percentage to revenue in the second quarter was 16%, 16%. And this went up from 14.5% in the first quarter. So there has been a quarter increase in our subcontractor expenses.
Yeah, thank you, Chandru. And because the travel has not yet opened up, we have a lot of H1 visa-ready people who are still there with us. Now that it looks like that it is going to open up, I think that there is an opportunity that we can actually make these employees travel and replace our subcontractors. So the objective is that we come back to a 13% or so level or 12% level with the subcon, because that had been our generally the percentage of subcon expenses.
That is helpful, sir. If you can just address on the ERP part and just a follow-up to what you said. Completely appreciate our bookings number. What I'm trying to understand is with the increased headcount, should we expect or what's the mix of increase? Is it more hunters or it is more farmers? So I'm just trying to understand that perspective.
I think it is in the both the side, but Roop is here in the call, so let me ask Roop to give the more qualitative answer on the breakup between the hunters and farmers and how we are utilizing that on enterprise solution side as well as on the other offerings.
So, thank you, VK. So with our focus on our top 36 accounts, we've bolstered up our account management headcount. So this is to ensure that we're catering to our clients. That's one area. So addition has been in account management, which is existing clients. The second area is enterprise solutions. So we've created a dedicated sales force for both our SAP and Oracle sales. And these are individuals who come with the background that is needed to be able to be successful in enterprise solutions. So as VK very rightly said, it's a mixture of both account management and net new.
Perfect. Thank you for taking my question and best wishes for 22, sir.
Thank you.
Thank you. The next question is from the line of Ashish Agarwal from Principal India Mutual Fund. Please go ahead.
Thanks. So most of my questions have been answered. Just two things from my side. First of all, given our growth rate and attrition, do you think this type of utilization is sustainable over a medium to a longer term basis? And secondly, on the enterprise business, if the growth returns in that, and it seems that you are very confident on that, do you think that could be a lever for the margins also?
Okay. Yeah. So first of all, let me answer the enterprise solution side. The margins are better in the enterprise solution side than into the newer deals in digital or similar technologies for a simple reason that these are many clients who are there for many years. And we have the execution engine already with us that is really delivering us the better margin. Any new deals by the nature will always come with some level of investment from our side. Okay, so in the beginning, generally the margin will be lower and slowly we start to pick up the margin with every such deal. So from that perspective, remain confident that the enterprise solutions will always give you better margin, especially in our Birlasoft case, it will always give us the better margin. So that is one thing. Second, when it comes to the growth rate and attrition and having the utilization at a higher level, if you look at that very carefully, we need to really look at how do we utilize our bench very effectively so that we are able to improve the utilization on the billable side. Okay? It is all about how do you utilize your bench and how quickly can you upskill them so that you can utilize them in the engagement very, very quickly. And I think that improves the utilization. So I believe that 85% or so is sustainable. Now, the good part is that it is giving you an edge of about 1%, so that at any point of time, if you want to look at more investment for a particular client or for a set of clients, you have that headroom. Today we have that headroom. Rather than giving the utilization which is very lower than 85%, and you find that the headroom for the investment has completely dried up. So from that perspective, I believe that there. But at the same time, on the other side, we have to look at is that how do we continue to increase many other elements with respect to the pricing, the rates, okay, or many other levers that we have planned on the pyramid side, so that we also improve the margin, because both have to go hand in hand.
Got it, sir. Got it. Thanks a lot.
Thank you. The next question is from the line of Dipesh Mehta from Emkay Global Financial Service. Please go ahead.
Yeah, thanks for the opportunity. A couple of questions. First about Europe. If I look, Europe continue to remain weak for us. Last time you indicated we are taking some corrective actions and we expect some recovery to happen in Europe. So if you can provide some update on the progress which we made, where we can see recovery happening in Europe. Second question is about other expenses increase. Now we have seen 280 basis point increase in this quarter. 150 basis point explained by subcon, but still it is 130 basis point higher. So if you can provide some detail about what is driving higher other expenses and how sustainable it is. Is it driven because of some one-off item or it is more sustainable uptake? And last question is about OCF. So cash conversion, if I look H1 remained fairly weak compared to let's say last year. So if you can provide some perspective how one should look your cash conversion. Thanks.
I'm sorry, what was the last question, Dipesh?
Cash conversion. So if I look this year we have generated 59 crore OCF versus last year 300 crore.
Okay. So I would ask Chandru to answer the second and third question that you asked. Okay, but Europe, let me answer you first. On the Europe side, we have started putting our chips on the table. Have started to see some improvement, though the result may not be seen in the quarter two, but we made a good win with one of the clients in the quarter two, which is part of our net new revenue. It is a new win that has happened in Europe, and you will start seeing that there will be a growth in the revenue that will start coming from quarter three. Okay, so that is already happening, and we have started to go after those deals. So that is one element that is there. As far as the other expenses are concerned, I think Chandru did answer that question before, but I will let him clarify that again. And also on the OCS side, he can again provide the answer.
Yeah, sure. While the primary driver for the quarter-on-quarter increase in other expenses was subcontractor cost, there was also some strategic investment that we made in our effort to drive to our $1 billion aspiration that DK has set for us. So that cost as well was in our second quarter number. Right? Your question was, is it sustainable? The answer is yes. We expect that the subcontractor cost will slow down based on some of the efforts that we're making that DK already talked about, and when travel opens up, when the whole attrition situation kind of abates. Your third question was on the operating cash flow. Why is it lower in the second quarter? There were three items that we had to bake in. One was there was a dividend payout in the second quarter. This was the final dividend announced in the month of May, and we paid it out in August after the general meeting. Second, we also had to increase our outlay in our working capital in order for us to fund the additional growth that we had in the past quarter, and the advance tax payout in India and some of our larger geographies also took some cash payout, which is why you see our cash flow in the second quarter being lower than the first.
Yeah, just on the second question about, you said we are making some strategic investment to accelerate revenue growth in our 1 billion aspiration. If you can provide some more detail, what kind of investment we are making?
DK, you want to talk about that?
Yeah, I think you're saying for the $1 billion, right?
Yeah.
Strategic investment I'm referring to.
Yeah, strategic investments. Yeah, correct. Yeah. So there are quite a few investments that we had to look at. One is definitely that we need to firm up our strategy. Okay, and the strategy has multiple elements into it. One is that what are the newer technologies that we should develop, okay, or what are the capabilities that we need to develop in the newer technologies or emerging technologies, okay. That is one type of investment that has to continue to happen, okay. Second is the domain expertise that we need to do, because we have moved from vertical to micro vertical, and when you're going into the micro vertical, you need to go and demonstrate the domain expertise in those micro verticals and in building and proposing the solutions. So that is also the second level of investment that we have to do in order for us to go and capture the demand that comes our way with respect to providing the industry-specific solutions or platform-specific solutions. That is the second thing that is there. Third is that we are also trying to engage on creating a full-blown strategy for a billion-dollar company. Okay, and that requires M&A also to be a significant part of that, because when we had to look at the M&A, we had to look at what is the kind of candidate that we will go after, and efforts in order to identify, work on that, and also ensure that we are going after the evaluation of the right set of candidates. Okay, so some level of consulting charges that will be there on that front also. Those kind of expenses are definitely going to come in that front. So these are the 3-4 type of significant level of investment that will happen. Now, if I look at on the other side, is that how do you continue to have a larger set of feet in the market? That means that am I hiring more account managers and the hunters, and also looking at structuring my sales in a way that I can take the advantage of the offering that I have. For example, 6 months back or 9 months back, we came out with this whole channel strategy. We crafted that as a separate team so that we can focus along with our OEMs. That has shown us some good result. Okay, so what we have seen is it is worth investing the effort and money on such kind of structural changes also in the organization, so that we can capture the better momentum.
Understand. Thank you.
Thanks.
Thank you. We'll take the next question from the line of Nirmal Gohil from Union Asset Management. Please go ahead.
Yeah, thank you for the opportunity, PK and team. Congratulations on very good set of numbers, sir. Sir, I just want to understand the segmentation of your service line, in which you include business and tech transformation, enterprise and cloud. Now, understandably, what our understanding is on enterprise is that the way in which ERP solutions will be delivered incrementally will be more SaaS-based, and thus the way in which it is delivered is changing. So on-premise is going to shift to cloud. So basically what is happening is your the higher number of on-premise customers you have will probably shift on cloud, which means incremental revenue growth will come from cloud-based revenues rather than enterprise solutions. So I just wanted to understand further your comment on the standalone enterprise solution doing well despite having some sort of a greenfield presence. That is point number one. The second point is within business and tech transformation, how much of your revenues in this particular service line would you broadly, if you can give me a broad number over here, what would be the split between pure digital services and maybe legacy ones? Those are my two questions. Thank you so much.
In the business, you said in the business and technology transformation, right?
That's right. Yeah.
Yeah, business and technology transformation mostly will be your digital revenue, mostly. Okay, there could be only 1 or 2 items that might be there, but those will be not very significant. So you can assume that 90-95% of that revenue will be digital revenue. Now there will be certain digital revenue that we count. If somebody counts the way rest of the industry does, for example, cloud revenue, you can count that as a digital revenue. Many of the companies do that. Similarly, on the enterprise solution side, some of the SaaS solutions such as CRM can also be counted as a digital revenue. Okay, but we have kept that as part of the enterprise solutions, because if SAP CRM is getting implemented, we consider that as part of SAP and not as a separate digital revenue. Okay, because somehow all these enterprise solutions are also becoming equally digital. Okay. Now, your question about that, the cloud-based solution, SaaS-based solution, most of the ERPs are going to move to the cloud, and how do we look at that? If there is a SaaS-based Oracle or SAP solution, we count that as part of the SAP and Oracle only. We don't count that as a separate cloud solution, okay, or cloud revenue. The cloud revenue that we have talked here is mostly around the application modernization or infrastructure migration to the cloud. That is what we have counted here rather than counting everything, because cloud could mean anything to everybody. Okay, anything to anybody, it can be counted. So we have segregated that so that we can very clearly define what is going to be the cloud and what is going to remain attached to the OEM, because that is the way your relationship with OEM works. They do not want their revenue to be broken into the CRM separately, ERP separately, and cloud revenue separately, SaaS separately. No, they want everything to be in one bucket, and that's the reason we keep that as part of the enterprise solutions.
Right. Just to understand, I mean, the cloud-based services that you report, and as you just said, that this will be more application modernization and, so would it be fair to say that while the growth in cloud-based services is higher currently, but the most structural story for you will play out within business and tech transformation? Would that be a correct assessment? Because at some point in time, most of the application, warehouses for clients would have modernized and would have gone into cloud. Post which you can cross sell other services like maybe analytics or mobility, etc. on the digital side. So on a structural basis, on a long-term basis, the business and tech transformation is a more sort of in terms of growth, that could be a better growth story as compared to cloud on a longer-term basis. The near-term growth, of course, will come from cloud.
No, absolutely, because at the end of it doesn't matter whether you are on cloud or on-premise. So far, you are able to get the business value that you are asking for. Okay? What has happened is that many times now, by having Azure in place or AWS in place or Google in place, there are certain type of value that is part of the cloud that one can leverage when they move some of their applications and data to the cloud. For example, if you want to have better analytics story, one will move to the Google Cloud because they are very strong in the data analytics side. Similarly, if you want to move your ERP pieces there, okay, or industry-specific solutions, probably AWS and Azure will be far better, okay? And at the same time, SAP has much better solution actually on the Azure, okay? That is the way how the clients are moving. So at the end, what we have to look at is that whether we will be able to deliver the services or upsell the services once somebody is on the cloud. Because migration is not a big ticket item. Many of the migrations are just lift and shift and may not have significant revenue. But the significant revenue comes when the clients want to transform after they have migrated to the cloud. And that revenue we will see as part of the digital. Okay? So your observation is absolutely right that eventually the organizations want to transform, and that kind of revenue will be far more sustainable when it is part of the business and technology transformation.
Fair enough, TK. Glad that I understood it right. Thank you so much, and all the very best.
Thank you
very much. I now hand the conference over to Mr. Dharmendra Kapoor for closing comments.
Yeah, thank you very much, everyone, for joining the call and asking very pertinent questions, because these are the questions. It is always good to reflect after every quarter as to, one, are we directionally right? Second, the commitment that I have made to the market as well as to ourselves within Birlasoft, that we want to be a very, very predictable and sustainable company. I'm very happy that it was the fourth quarter where we had shown quarter-on-quarter consecutive growth. And it is looking now clearly visible that we will continue to show quarter-on-quarter growth for a very long time. Okay, so that is one thing. I know there is momentum in the market also, but then the organization has to be prepared to capture the momentum that comes their way rather than, really looking like a cat on the road where we are not able to run in either direction when a car is approaching. So I think this is a good position to be in. I know that we need to improve again on the EBITDA side. We improved from 9% to 16.9% in those 5 or 6 quarters after acquisition of KPIT's IT business. We grew to that level, and then we have seen this attrition and higher cost of resources hitting us by about 200 BPS in the last 2 quarters. But I am very confident that with this whole attrition softening up in a quarter or so, I think we will start getting back to where we were, because we have already tasted how to be there at 16.9 or 17%, and there is no reason why we will not touch back to the same place where we were in the quarter 4. So thank you very much for all your support and your participation. I am looking forward to continue to show better and better quarter going forward. Thank you very much once again. Stay safe.
Thank you very much. On behalf of Birlasoft Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.